Hi, this is Alex Goldovsky, CEO of Fort Schuyler USA, One Diligence, and Doc Solution. I have a very special guest, Paul Mangione, CEO of Fort Schuyler Advisors. Fort Schuyler Advisors is a New York-based advisory firm focusing on structured credit, consumer and residential whole loans, and asset valuation. We met with Paul a number of times at the conferences. He's well respected in the industry. He's always a speaker at the conferences. If you don't know Paul, I suggest you find Paul on LinkedIn, connect and follow for great data analysis for the current market conditions using the latest released data and, of course, trends on the key parameters of the market. A lot of banks use Paul's firm for analytics and prediction of what's going to happen in the future. So I'm very excited to bring Paul to our podcast. Welcome to the podcast.
Great. Yeah, thanks. Nice to be here, Alex. I was looking at one of your books from the past that I think we had met. One of my colleagues, so we had met before, but then one of my colleagues had given me your book, and so that's why I think we connected. So great to reconnect then, and happy to do this.
I hope it wasn't too boring. It's really, whoever's interested, they can buy my book on Amazon. If you need to learn about title and title defects, title liens, and things like that. But, one thing before we start, two news items that came out today. First one was that Moody's downgraded 5 banks with a large commercial loan exposure, including Washington Federal, right? After the sale of a large portfolio of assets, commercial assets, by Washington Federal to JP Morgan and Chase, Moody's still downgraded the bank. So I really wanted to touch on the status of, banking health, financial institutions' health when we talk. And also the second thing that I wanted to touch on, which really leads to the first topic that I wanted to touch with Paul, was that jobs report just came out higher than expected, adding 272,000 jobs in May, while the street expected 180,000 jobs. To me, that translates to Feds keeping the interest rates steady without cutting them in the summer, and then probably keeping the same rates flat through the end of the year, as they don't want to cut before the election. But that's sort of my view of the world. I'm curious to know what Paul thinks, and let's start with the state of the market for actual consumer, right? For some reason, I think that consumer is, scared. We're adding jobs, but, I feel that there's some weaknesses on consumers' perspective.
Yeah, I mean, I think you're right, and you see it anecdotally everywhere. The jobs number, I think was today, is 272 versus expectation of 190. Payrolls. I think what people should be aware of is the revisions, right? And that's the kind of thing that we look at. Revisions, years ago, you would see revisions of 2,000, 3,000, 8,000 jobs on the payroll number was a large revision. Now we're seeing like revisions 25,000, 29,000. So the process of them just getting these numbers is always a challenge, I think, today. The surveys, these are done via survey, and I think the response rate on the surveys is like on the order of 30%. So it's really a model that's really generating the initial number that comes out at the beginning of our month, the previous month. The one thing to look at is the quarterly payroll numbers that comes from the Census Bureau. So the Census Bureau actually provides quarterly numbers, and that actually is directly from employers that are required by law to report to the census the number of employees they have. And what happens is the last quarterly number that came in basically showed they had overcounted payrolls by 500K, right? Wow. So we are seeing over the previous quarter. So we are seeing, you're right. We're seeing kind of the consumer maybe feels weak, but the payroll number may not express that, right? So there's two reasons. One is the numbers are probably the collection of the numbers has just changed so much post-COVID, and the response rate on those surveys. And the second is really kind of the focus on part-time work versus full-time work, right? So although the employment number doesn't make a difference, the unemployment number, the percentage, doesn't really make a difference between you're employed or unemployed. If you're part-time or full-time, the payroll number is counting, each job. So if you have two jobs, you count as two, versus if you're employed versus unemployed, right? You're not double counted. So it's people should really look for that census number that comes out quarterly, and then that gets you to how do people feel? I think people feel more stress because of where inflation has affected their buying power, and it's really the wage growth versus the rate of inflation. And had increased wage growth during COVID as people got their stimmy check. They got lazy boy, lazy girl jobs, right? They were able to handle those, get those jobs, and people were quiet quitting for taking the summer off, or were getting, paid 20% more, stepping over to another place. And that's where we're not seeing those same job growths, wage growths that we saw then. And we also have, you are starting to see layoffs. And so people are concerned. One important thing, we could bring up some graphs later, but I didn't prepare a graph for this, was the quit rate. So the quit rate is the percentage of people that are quitting their job every month. And, that number has been collapsing. It, was, I think, high, like 3 to 4%. Now it's like getting, below 2% for private employers. And why don't you quit your job? You quit your job because you don't think you're going to find something better, and you're kind of hunkering down. So I think between the quarterly census number on payrolls and the quits rate, and that kind of gives you a better sense of like what the consumer is really feeling.
Yeah, so I can echo exactly what you're saying. I get the consensus questionnaire every quarter for two of my companies, and the only thing they ask for is number of employed in the given states and the total compensation. That's it. No breakdown on hours, just the total numbers, right? So that's
that's the census survey that and you're required by law to do that. So that you're going to get a very high response rate versus the monthly number, which is, very, a different response rate than we had, let's say 10 years ago.
Yeah, and quit rate, it's very interesting parameter to watch, because in the same news article, the unemployment rate ticked up to 4%, which means that there's less, I guess, work available, and therefore the quit rate should be lower, because there's no other options. You really have to hold on to your jobs. So from the consumer perspective, I think what we're both saying is that consumer is now more afraid to lose the job. There's not enough jobs out there, or the amount of jobs is much less than it used to be. The wages are still low. So what is the sort of, how does the consumer feel today?
They're concerned about prices, right? They're concerned about getting enough work to pay their bills, to feed their family. And, now you're kind of starting to see that get expressed in their ability to make their, make their payments. And so maybe I could pick up one. I'll show one graph here. I'm going to say and see if I can share it. It's really on the overall amount of. Here it is. Yeah, so let me clean it up here. But what this is just showing our see, just make it in full page. What we're showing is this is this is from the Fed, New York Fed, and what this is showing is the 90 plus delinquency by different product type. So for the consumer, so student loans obviously collapsed post COVID as people went to a deferment, and mortgages are, rates are very low in terms of delinquency because of how much equity people have in houses. But the blue line, right, that's credit cards. So, let's say in 2023, people were saying, okay, it's normalizing, right? It's getting back to the traditional levels that were there before, right? It got to those levels and then blew right through it, right? So it's now, kind of like above, 10%, and it's kind of continuing to go. The numbers I typically look at from the Fed, which are the commercial bank numbers, are much lower. But it's, here it's kind of like very clear where it's going. And so you can see like the last time it was at these levels was 2008. And so the fact that credit cards, and these are all credit cards, so not just prime, not lower FICO borrowers, is everybody. Auto loans, looks like green line, that looks like something similar is happening there, right? And these are all auto loans, not prime or subprime, broken out separately. Had, when the stimmy checks were coming in, all these other transfer payments were coming to consumers. 2021, people were making their payments. And so when you made your payments, you lowered your debt, delinquencies went down, your FICOs actually went up because lower utilization rates on credit, people really had nowhere to go. COVID, post-COVID, they were doing their spending, and now you kind of see the difference. We are spending, but we don't have the money. And so now we're starting to see consumer, and these are high levels. These are not insignificant. Like when you look at, 2012 through 2017, the numbers were like sub 3-4%. At the levels we're at now, we're heading to 5%.
So what screams at me on this chart is in great financial crisis, the delinquency on the mortgage and the delinquency on the student debt was sort of flat, was following the curve of the credit line, right? So you have a ramp of credit card delinquency going at the same rate as the mortgage delinquency. While today, the mortgage delinquency is down, the student debt is way down. Most likely, again, I'm trying to marry the news, is the forgiveness program by Biden administration. But why you don't, why you think the mortgage delinquency doesn't follow the credit card?
It's the main reason is because you have equity, right? And so we can get into that next. The amount of equity that we see in properties is at the highest it's ever been. I mean, it's in the trillions, and we can look at that next. And the one thing the other kind of, the purple line is revolving. So the HE revolving. So that's home equity revolving, Helocs primarily. And so, it's similar to the mortgage, low delinquencies, continuing to go down. But why is it fall in the line? It's because we have equity, and if you have an issue, you can always sell your house. That was the focus in the past, and it still looks like there is a lot of equity. If you go, let me see if I can switch over.
Yeah,
we'll go over this. Okay, this is from the Urban Institute, Laurie Goodman. I've been following, her chart book she does on this every month since probably 2017. The blue line is the total value of the single family property market. So 44.8 trillion. Mortgage debt outstanding, 13 trillion. So the net difference is the housing equity, 31 trillion. ICE, does a similar product, but and they have a different way of splitting it. I had a discussion with them a few days ago, just like they were showing 16 trillion. So I said, well, how do you get 16? You know, everyone's showing 31. This is, you know, from Fed data.
Yeah.
And they had said we're looking at only properties that have a mortgage, right? So it cuts down the number, and then they talk about tappable equity. So they show 16 trillion of total equity, 11 trillion of tappable equity. Tappable equity means up to 80 CLTV, effectively. So it's a different way to cut it. I could see their point is that if you don't have a mortgage, the chances of you going out and getting one is probably a little less likely, versus if you have an existing mortgage and you could do a cash out refi or get a second lien. So you could look at, you know, either way, but there's all this equity that clients have or consumers have. So, you know, they're not going to have an issue for some time. They could always sell. They can potentially refinance. They can get maybe they can get a roommate, you know, so they have an asset that can actually maybe try to get additional income.
Well, so let me just, before we jump into the equity, if you go back to the chart with the delinquency rates, from what it sounds like, folks that own a home, right? Yeah, this one, they have an ability to sell, sublease, or, you know, tap into their equity. While if you look at the renters market, maybe those credit card delinquencies are showing, for the majority of the rise, contributed to the renters, and therefore there's a split economy between homeowners and renters, right? So in other words, homeowners still have way out.
Yeah.
Right. Still have the renters, they don't. Right.
Yeah, and that's a good point, and you're a good straight man. Let's see if we can. So this is transition. But let me see if I think I have by age. Okay, here it is. Credit card by age. So this is serious. So this is not delinquency. This is the transitions. I don't know if let me see if I have delinquency. No, I don't have. So I have transitions. So you can see the blue line at the top is 18 to 29-year-olds, right? So they're transitioning at a higher rate as would be expected, and then 30 to 39-year-olds. So you're probably right in your point there that it's the fact that if you have less assets, you're going to be running at a higher rate, and the less likely that you own a home at 18 to 29, you're kind of converting into 90 pluses at that higher rate. Similar for auto. Let's see. So I can bring that auto. Similar transition rate for auto. And this is, again, from the Fed. 18 to 29. Obviously, it's a lower rate in terms of that. We were looking at 8 to 9%. Here, it's now 5% for the 18 to 29-year-old. You need the car, right? You got to get to work. You got to get around. You got to still kind of make that car payment. And then, let's say you go down to, the 40 to 49-year-olds, like much lower rate. We go back to credit cards. It's lower. It's not as low as on the auto side. But so that's it. That's our kind of, and this is the transition for everything, but these are the 90 plus. So this is the original graph we were looking at.
So majority of the rise for the credit card delinquency are young people getting into debt, getting into credit card payments and auto payments. They don't have any assets, and sort of that's the view of how to rationalize this chart. And just on the other side of this, I guess Fannie and Freddie portfolios are pretty clean, while Ginnie Mae is getting higher on the delinquency rates, and that would tell me that the real estate prices would need to fall to actually see that yellow mortgage line go up with the same rate. Yeah, the same rate. Go ahead.
Yeah, and that gets us to, why doesn't it kind of happen here? Let's it's really about what's the trigger point, right, to make you have to sell your house. And if you go back to 2008, 2009, right, the trigger point was payment shock. There was a lot of properties that were ARM loans. They were, right now, originations are more or less than 10% ARM loans. So there's a lot less payment shock. And then you also have a very high percentage of fixed rate under, I think 60% or under 4%. We have some graphs on that we could talk about. Let's see, go to that. Right
also
here.
Non-QM, which is about 5% of the market, right? Which has higher than fixed rates.
Yeah, so here is the breakout by interest rate. Again, this is from the Urban Institute. So, most are, 3.5 to 4. So you've got this huge amount. There's very few that are, look the slide before it. This is the refinanceability share, at least the agency loans. It's like nothing. There's not any significant amount of, maybe it's 3% of agency loans are refinanceable from a current rate standpoint. This was as of April. Rates have only gone up a little bit since then. And so you're kind of dealing with people that have low rates. They're going to stay. There's no trigger point. The share of ARMs, like I said, is very low of new originated property. So what is going to put people in a position to have to sell? It's not going to be payment, although, we've seen issues in California and Florida around insurance costs. And then also on the coasts, the east coast of Florida, condos, unfunded, escrow or unfunded capital requirements that they need. So they got to fund up. So, you're seeing a lot of stories about even young people and even older people that they have to come up with a $20,000 check on their condo and they don't have it. And they're just like, I don't know what to do. So I'm sure there's going to be other options people have, but that's a one-time payment. Your payment and your total payment P&I plus insurance, like that's where those have gone from maybe they were $22,000 to now they're $2,600. Like that's big when you kind of set up your budget for $2,000 a month. So that is a payment shock. But other than that kind of payment shock, the other shock really has to be employment, right? So your loss of income or a reduction of income, I think, is really the only shock for the country as a whole that can cause higher delinquency in mortgage, like you're talking about.
So what's interesting is to monitor. That's a great point. And just to piggyback to your capital contribution comment for condos, what's interesting is to monitor all the investment properties that are condos in Florida that have renters, that go delinquent, that lose the jobs, and now there could be a point of the forced sale by the investor if they can't find the good tenant who is, paying for their rents and paying for the credit cards.
Yeah, the good thing is Florida's not having a problem. They don't have enough workers, right? So we go down there. I think the unemployment rate in Florida is, sub 2%.
Yeah.
So that's the one benefit, is that there's plenty of jobs there. The income may not be at the level you need to get there, but there's definitely. So I don't think we're going to see issues like that, especially. And I think we're still seeing the kind of migration from high tax states to low tax states. That's still happening, even though a lot of positions are back to the office. Like we are seeing good employment numbers in Florida. It's just a matter of finding those other places where you have those high insurance costs, and I don't think it's just a Florida and California thing. Those have they're happening everywhere. It's just not as pronounced, not as a high position. Maybe people's insurance goes from $2,000 a year to $2,500 a year. It's doable, right? That's only only a little a month, so you're not going to have a huge issue there. Versus people who are going from like $2,000 to $6,000 or something like that in some of these some of these locations. So that's the concern. But the payment shock is not like if you look back at 2004, 2005, 2006 on this graph, like 35%, and those were usually 2-year or 3-year loans, and the payments that would step up like several hundred basis points. Where we haven't, although we have seen rates go up, that's not for existing homeowners, or that's for people, new homeowners. And so that's the issue that obviously young people are having is the payment now. It is cheaper to rent in a lot of locations than to nationally, definitely if you look at the national numbers, but most markets it's cheaper to rent than to own, and it's because of all the numbers, all the things we talked about, plus a 7% 30-year mortgage rate.
So I guess in summary, you don't see the crash, you don't see the huge unemployment rates. It's interesting from your position. I mean, I was on the opposite side of the camp. I thought, oh my God, all the layoffs and all the credit card debt and auto loan debt and all this stuff. And what your data shows is that it's really folks that don't have equity in their home that are in trouble, right? You still have some options for the homeowner to go and homeowner, not the renter, to go and grab the money. Helocs close in seconds, home equity contracts, or figure out the way how to sell the property and move into renting the place, right? So let's touch on what do you see on the seconds and Helocs market? I would expect in our analysis to say, all right, we should see an explosion of closed-end seconds or Helocs, but I don't think we do. So how do you look at that data?
Yeah, let me see if I could share some more here. Screen. So yeah, we'll go back to some of the charts here. So this is the Google Trends on searching for the term Heloc, right? So some goes back to 2010. So it has a little bit of a rhythmic kind of up and down, as people kind of, either they're looking, I think it's like kind of like plateaus in May. But what you're seeing is like after, 2021, it really kind of spiked up, and now we're kind of seeing, and this is a relative number, right? So this obviously more people use Google now, but it's just showing that this kind of really focus on what Helocs are. And Helocs are an old product, right? Helocs are not new. Helocs was a kind of boring banking product that you get from, you'd walk in and you'd have your banking relationship, and they may not have your first lien, but they give you a Heloc because they knew you. And banks loved Helocs because they were indexed to prime, which was their funding rate. They would have a low origination cost because it was a walk-in product. You were already there depositing a check. And the other point was that it would say that that draws were free, meaning they would originate, they'd give you a draw. The Heloc would be a premium value, but every time you kind of drew, it was almost like a free, a newly originated Heloc, right? Let's say you got a line for $100,000, you draw $20,000 when you first got it, and then if you drew another $20,000, 6 months later, the bank would own that, could sell that asset at a premium, but they only had to allocate, send out par for you. So there was very low allocated cost. And the original Helocs, you get like a checkbook. So it was a very kind of old school product. So, but now we have this place where we have equity, and we're looking at like, what are we going to do with it? So Helocs are now kind of the focus because what we showed before, let's go back to rates. Rates are much lower, right? So, mortgage rates that are allocated already by consumers are much lower. The average is probably in the 4s. A lot of people have it, kind of in the 3s. but they have equity. Their house went up in value. They wanted to kind of, let's say maybe they're at a 60 LTV now. The Heloc could take you up to 75, 80 CLTV, and you don't have to lose that low interest rate. And that's, this is something that we've really never seen before, is that this much of the mortgage market at this low a rate. So the refinanceability is zero, and you're really, and let me see if I got some other graphs that probably talk about, but the one big piece is that the volume of mortgages, here it is, first lien origination, like the 2023 numbers, one person told me that they were the lowest of all time. Here it shows like 2014 was kind of low, and before that 2008. They were saying it was the lowest in like 20 years, and maybe, measuring just agency origination, that might be the case, but it's low, right? 2023 was a low number, and that's because no incentive to refi. It's only purchase loans. No one's doing cash out refi like you were seeing in those huge spikes in 2020 and 2021. So now the sector is going to be really dominated by HELOCs, closed-end seconds, and HEI, just because it is, from a overall interest cost standpoint, better for the customer. And I guess there's versus like taking out a consumer loan, taking out a credit card, the interest on a closed-end second. I'm not sure about HELOC, but closed-end second is, you can take it out of your tax, you can take it off your taxes, similar to the first lien. So you could take a deduction for your interest, and versus paying with a credit card. The risk is, all right, if you don't pay, you could have the risk of losing your house, versus a credit card. You don't pay, you get your FICO hit, and you may have to go into bankruptcy, but you probably aren't going to lose your house. So obviously there's a much bigger risk to it. But in terms of where we are now, we're going to see that market. And if we go back to, I'll go back to like one of the early graphs. This one, where, let's see. I have another. I don't have another. The overall market shows second liens. This graph, I don't have it on this one. The second lien market, or the overall home equity in second lien, is very small. It's like 400 billion. So 400 billion is a big number, but not in terms of the mortgage market, right? The mortgage market is, 13 trillion. The equity is, 11 to 31 trillion, depending on how you measure it. And our focus is really going to be like, well, how do you get to something? Actually, this is a good graph here. Credit card balances versus HE revolving balance. These are actual numbers. So this is coming out of the Fed as well. They're probably more focused on what banks have. But you can see the dark blue versus the light blue, right? So the dark blue is credit card balances. So total balances, trillions of dollars, right? Versus the limits are 5 trillion, right? So there's a long way that people can go to draw. The bank could always cut you off, but it's at least kind of incentive. It's viewed there. It's available right now. And then for HELOCs, much different number, right? HELOCs, I said 400 billion, but this looks like even lower here. And the overall, the dark blue, and then the limit is up here under $1 trillion. So if you think of that, if let's say 11 to 31 trillion of equity versus is only 1 trillion of, and kind of like outstanding volume right now, 1 trillion of line available, and then 400 billion of actual drawn. There's a lot of focus. You also mentioned the HEI, home equity investment product, which I've talked to a lot of the Heloc originators from a bank standpoint, at least. I said, well, have you guys run into this product as a competitor? And most have said no because they view it's the traditional HELOC versus, well, if you want to call it the traditional HEI, they're different, really, FICO customers. Like the traditional HELOC is going to be a higher FICO borrower. It's going to be 700, 720 plus. HEI is going to be lower. It's going to be more in the, maybe 620, maybe this to 680, because it's not dependent on your FICO. Although those issuers will, and they're not lenders because it's an equity product. So that's the point. They're not really focused on the client, the consumer, as from a credit standpoint. They're focused on the equity in the product. And so that's something that I guess the banks have really not seen. So they're not really losing any business. Those issuers or those originators are, those companies are presenting some of their clients that have homes with another option, cash up front. You don't have to make any payments. You have to maintain your house. And, when you sell your house or we're at the end of the contract, you have to kind of, make good on the contract.
Well, let me jump in, and I wanted to sort of step back to what you said, and give you a perspective from sort of my view. I came back from the business trip in Dallas where I visited two major servicers, and probably people can find out who they are, who is a major servicer in Dallas. And we did talk about HELOCs, and we did talk about closed-end seconds. And there's a lag of rolling out of the new products, right? So when there's an opportunity, as you show by these numbers, all the major originators, servicers are now just trying to get the workflow pipeline ready for the massive amount of HELOCs and closed-end seconds, right? There was a lag of about 6 months of prep time for all the servicers to say, oh, now we're ready to take on those type of loans, right? Before it was a very tiny volume. Now it's still low, as you pointed out, but the numbers point to, with the high delinquency, people will start tapping into those programs. So that's part one of the whole puzzle. And part two is securitization aspect from capital markets, right? So HELOCs were sort of very low on the securitization list for the rating agencies, and now everybody's talking about, right? So DBRS was first one that packaged a large portfolios of HELOCs. There were some securitizations of, Spring EQ-like securitization of a blockchain and a liquefy mortgage and things like that. So folks were playing around with it, but it's still a low volume. And now JP Morgan Chase came out with the HELOC securitization, where they managed to securitize HELOCs, not closed-end seconds. That's a standard securitization for, with the policy or without the policy, with the insurance wrappers. But the HELOCs, people were trying to figure out how to securitize those as you draw every month, and you would basically securitize every slice individually. And JP Morgan was first one that made it happen. So that was quite exciting. And I think that would open the door for more volume to go through the servicers and through the rating agencies, both HELOCs and closed-end seconds, right? Is that what you got?
I'm laughing a little because it's all been done before.
Yeah.
It's just like either all those people like have retired and not been around. But that was one of the first deals I worked on at First Boston, was a HELOC securitization for a bank, and what they and why is a HELOC more complicated in a securitization than a closed-end second, right? So the HELOC is more complicated because of the draws. So you can handle the draws two different ways. You can make the draws a part of the securitization, and then have a way to fund the draws in the securitization through either they used to do it through some variable funding note or some commercial paper issuance, like to get really complicated. Or you can make the draws like a one-time thing, and new draws would have to go to a new securitization, essentially. So there's a few ways to do it. The draws are important because they effectively additional, the debt against your property. So you got to know exactly where you stand in terms of your CLTV as your ultimate, from the investor standpoint.
Yeah.
And the draws can happen. Now we do it at the touch of a button. Years ago, you might have to go into the bank, sign a paper, like it can only happen once a quarter or something like that. Now you can, click on your phone and you got a draw. So from a servicing standpoint, right? The servicers, if they haven't serviced HELOCs before, it is a hard thing to actually try to get that into your system because of your loan balance going up. It's not something that most servicing systems really contemplate. And if you have an older system that didn't anticipate HELOCs, so I'm not surprised that the servicers, have a fair amount of work kind of like dealing with it. And then the rating agencies, again, they've rated HELOC deals before, starting in the 90s and the 2000s. It's just a matter of understanding like what's backing your collateral. Is it backed by is your draw senior to the other draws, or all the draws at the same level? And then like just making sure you have all the numbers correct. Like I remember one of the deals, this bank would do a deal like every quarter, and I would have to like track so every loan or every HELOC would have like 6 balances, one for every quarter, and then every time a new deal came up, we'd have another balance. So we'd actually track the balances, but then you'd want to have to explain the traditional CPR rate, so the prepayment rate. Then we would have a draw rate, which would be kind of CPR, but calculated for the percentage of the balance went up, effectively the annualized increase. And that's important because for the investor, the end bond investor, they want to know what's their duration, right? So typically these deals from a securitization would have a revolving period where draws would go into the securitization and would extend your investment essentially. And then after that draw period ends, you're basically in prepayment only. And
so Paul, let me just jump on this topic because I really wanted to understand it and cover. Since we're talking about the investors now, we're covering sort of a bond investors into the HELOC and closed-end seconds. I want to make sure we don't leave without talking about the home contract, right? Home equity contracts.
Yep.
That you sort of explain. There's no securitization market for it yet.
The HEI?
Yeah, or there is.
There is. DBRS put out their program, their methodology, I think back in October of last year, and there's been about 3 to 4 securitizations. Unlock and Point has done a few. So there has been securitizations rated. There have been there were even some unrated securitizations before that, but now it's a rated product. And each, there's about 6 or 7 large not issuers, but originators of the product. So they're all going to look at this sector. They all have some difference in kind of how they work, to the consumer, meaning, are you getting a share of the whole property or just a certain percentage of the equity? And what is your obligation at the end of the contract? The contracts usually last 10 to 30 years. And at the end of that period, you have to now repay a certain increase based on your initial draw, essentially. So let's say they take a valuation, and then based on that valuation, you sell a portion of your equity for $100,000. They may now, you have to pay back $200,000 at the end of the contract. And, that is, and then there's going to be some other methods on, the original base case. So they may take get appraisal or get two appraisals and then haircut that appraisal, and then figure out what the new property value is going to be. So that protects the issue, not the issuer. It protects the contract writer, because these are contracts. These are not loans. These are not mortgages. And each one is different. I think there was, you really got to, DBRS has an article you can kind of read and kind of breaks down the analytics. It's going to be way too detailed for us to get into here, but the terms are usually 10 to 30 years. And so in the securitizations, question is, well, how do you make payments, right? Because technically there's no cash flow. You as the customer, you get your money and then you don't have to pay them back until you sell your house. So how does the securitization work? And it happens a number of ways. One, it happens through, they reserve, let's say 6 months of interest at closing. So there needs to be a certain amount to pay current interest. The traditional method has been pay downs happen from the natural amounts of prepayments that happen through, the traditional phases of life, death, divorce, moving, new jobs, all that. People do eventually sell their house, even if they have a 3.5% mortgage on it. You got to move. You got to sell sometimes, and so the payments are going to come from that. Previously, in earlier versions of the HEI programs or some of the early HEI non-rated securitizations, it came from cash out refis, right? So as rates had gone down in 2021, 2022, early 2022, and the customer would go out, get a refi, and pay off their first and their HEI liability. So it is still a new product. I think the one focus of has been from a regulatory standpoint, right? So these are not loans or mortgages, so they don't have the same underwriting or regulatory requirements of a mortgage. But they are state regulated, and from my discussions with some of these HEI issuers, they have definitely engaged the state, each state, municipalities, state legislative parties to engage them and try to be dealing with all the regulatory issuance that they do need to kind of be in compliance with. So they're not in every state, specifically because either the market's not big enough or they haven't had the outreach. But I was in a meeting where they had some of these HEI issuers presented, and they're very focused on engaging the state regulators. CFPB has some reviews on you can just how you can make a point on your bank. You can kind of issue a statement as a consumer. You can do it on the HEI. I haven't really seen anything really kind of outstanding that was negative the last time I checked, except for people saying, hey, they weren't accepted. They weren't issued one because of some other issues either.
Well, so let me jump in. Let me see if I understood you correctly on how it works. Again, this is a new product for me as well. All of my 3 companies, they don't play in that product line. So for me, I'm always curious, but let me sort of comment and then ask a question. So my comment is, it sounds like it's very similar to HECMs, right? Where, you have some level of defaults on borrowers moving, which is the occupancy default, borrower's death, a change in marital status, and it's a long-term investment where investors don't get paid until the very end, right? So it sounds like a very, very similar structure, whereas it's attractive for long-term investment. But looking at from the investor angle, what are the risks? And the risks are, let's say there's the crash of real estate value throughout the country, the contract is based on the loan to value at the time of signing the contract. And if, let's say, the values of houses in California, where it's very popular, go down 20-25%, and the borrower doesn't pay, does that wipe out the contract, or it still sticks with the property, even though upon the sale there's no equity left to give to the contract holder? How
Yeah,
is that the main risk?
if I mean there is a risk to the investor, right? That's why they actually try to take a reserve. Sometimes they'll say, okay, your house is worth $500,000, we're going to market to $450 before we kind of strike the contract. So, but if, let's say, when it's time to kind of roll over and your house is worth $300,000, for some reason, like the borrower is not liable to make that payment, that difference, because it's equity, right? So you essentially sold a percentage ownership of your equity or your property. So that's why you're not going. That's why it's not considered a loan, is because at the end of the day, the issuer can lose money, right? They can lose money because they're relying on home prices, over the life of the contract, over thousands of clients, over, kind of like, hundreds of municipalities, not all happen at the same time. And, they do some review on the customer, but at the end of the day, it's really the property that they're really underwriting.
And the contract is not enforceable. Just, if you look at the actual mortgages, first lien or closed-end seconds or Helocs, you can enforce those mortgages and try to get a possession of the property. The contracts, you cannot, right? So you're just riding with the borrower, whatever happens, happens. So it's a high-risk investment in my mind. Is that accurate?
Yeah, I mean, I haven't read a specific contract to that standpoint, but it definitely is, the borrower's ability to pay is not what's being kind of checked, and it doesn't live with the property's reference, but doesn't kind of stay with the property. If the person leaves and sells their house, contract has to get settled then at that value. But it's it's kind of like a growing kind of it's a developing product. So, but I think we're going to see more of it. Obviously, you mentioned HECMs. HECMs is a federally regulated product, right? So there's a lot more review done from the customer. They have to basically take a course at this point. I think you've got to take like an hour course. You got to get signed off by kind of reviewed. You have to have almost like an interview. So, and there were a lot of fees associated with, or at least the previous version of HECM. So there was a lot of fees associated with it. So it was something that you probably didn't want to do unless you really had to, because of all the fees associated with I guess maybe the more modern HECMs are, a little better from that standpoint, but it's still if you can get a low cost mortgage, that may be a better way to go. But you're right. It's, it's going to be similar to HECMs, and it's a equity product, not a mortgage product.
Understood. Let's, in the time we have left, let's touch on, the other sort of credit market, in particular auto loans, right? So auto loans is, I guess, an interesting investment from the investor perspective, right? You see a high delinquency rates. Now you see a large portfolio trades on unpaid auto loans, and the delinquency rate is actually pretty dramatic, going from a few years back to current year.
I'll bring that presentation.
Okay, that's perfect. Yeah, it's they've been always securitized, right? So there's no issues in securitization. Servicers are ready for auto loans. I mean, it's what do you see on the auto loan market, and from both consumer and investor side?
I mean, it's pretty clear that two things. I think during the pandemic, people were paying up for new and used cars, right? You would see dealer statement, and it would say like, your car is, cost, $35,000, and then it would say dealer up, increase, and it'd be like 25,000. I mean, it was pretty wild that there was these huge up increases in just delivery charges or other paying, or just the value of the car because of the lack of supply due to integrated circuit, delays and things like that. So there was a lack of cars. People didn't want to take public transportation. People paid up for new cars. People paid up for used cars. The one benefit was rates were relatively lower. So you can get your prime auto loan, you get for 2.99% probably at that point. But now we're coming back to a place, there's two things. People turning in their cars or people giving up their cars, right? If you Google trends, I don't have a graph on this, but the give back car, it's not as extreme as the Heloc, but it's definitely something that people are kind of focused on. So they have a high payment. If they turn in their car when they're trying to do a trade-in, then, they may have to put cash into the deal, right? So most people don't have that ability to put up cash. If they really can't make their payments, they are, they're stopping. And there's actually a lack of repo people to actually go out and get cars now. So there is going to be one issue. I think, traditionally it was like $500 to repo a car, which is a pretty good size number. There's a lot of ways to track cars now, either with license plate readers and GPS and all that. So they know where the cars are. They don't have anyone to get them. And plus, that is a very hard job. And so if you had your choice, you may not want to do that. So there is going to be a lack of that. But the delinquencies are higher. And I think the last piece is that what I've been reading is on the auction sites or the actual auctions, dealers that buy cars at auctions, they would say, okay, here's the Chase auto auction, here's the Cap One cars, here's the repos. The banks used to actually put some money into the cars before they put them out to auction, right? So anecdotally, I don't have any hard data on this, but dealers are now saying, you know what, like these cars look a little rough, right, compared to what they're used to in the past. The banks like cleaning them up, doing some maintenance, getting out any, kind of like any dents or anything like that. They're not doing that anymore because they're not going to recover it. Before, dealers were paying up for cars because they didn't have any inventory, right? So if you want to earn some profit at a dealership, you got to have a car. Used car lot, they would pay up. So I think we're not seeing it in the numbers yet, but we're starting to hear. And then the other piece is like if you look at the Manheim auto auction numbers, I think it was up as high, that's the used car index. I think it was high as 235, the index. Now it's down to about 199. So the cars have not held their value. Certain cars have. Low mileage cars that are, under, they're only 3 or 4 years old. Those, I've seen, that personally, and then also dealers reaching out because there is an interest in selling those cars because people may not be able to qualify for the new car price. So, it's all anecdotal, but, it's kind of telling us a story that the value of cars has gone down. People can't make those high payments. And the interest rate on a car now, let's say back in 2022, it was 2.99%. It might now be 6.99%, 7.99%. That's a big number on your payment. And in the leases, years ago, you hear the lease would be like, no money down, $200 a month for a Toyota Corolla or something like that. Now it's like $3,000 up front, $4,000 up front for $350. So, those are all the items that people are looking at. Obviously, there's inflation and all these numbers that we're dealing with. But I'd say in general, you're going to, delinquencies increase, and it's really going to be driven by the job numbers. I think that's going to be the ultimate driver of the performance of auto loans. It's going to be where do you jobs come out. And I'd say for your viewers, like, you can always look at the monthly numbers, but then one good thing is the WARN notices. So WARN is those are for large companies when they're doing large layoffs. They have to put out a WARN notice it's a federal requirement, but it's done on a state level at reporting. So you got to go to each state and you look at the WARN notices, and you got to see, you get to know 60, 90 days out when there's going to be big numbers. And so there's one, I think each state has their own site, but I think there's one site that kind of covers all of it for all the states. And, that's a concern. Like, we are seeing, large institutions, we saw it back earlier this year with the tech institute, all the tech companies, like cutting back on their salespeople, cutting back on their account managers, cutting back on even the developers, right? So that's the highest end. On the lowest end, you have the opposite. You have minimum wage workers in California now are making $20 an hour. Well, the employers have reacted by either cutting people's hours, getting out of certain markets, adding in more automation. And so it's not as if it's something that you can hide from. It's just something that, you have to be aware of.
So, Paul, just to sort of put the full circle around what you said, my payments for my leased car doubled, right? I do love driving the new cars, but I have to pay double. If I'm the renter and I have a certain wage, and now all of a sudden I want to pay, for the nice car an additional $1,000 extra every month, I'd better get a second job. Maybe I want to get the night Ubering or Uber Eats or what have you. And hey, the unemployment numbers will look great because now I have two jobs to afford my one car at the higher payments, right? So now it's sort of starting to make sense.
Well, the unemployment rate you won't show up double counting the unemployment rate.
Right.
The payroll number will be counted twice. Yeah, I mean, you need to decide, do you want to have that high-end car if you can afford it? And I think that's obviously a decision that people make on a personal basis. And it's tough. There's not too many deals out there. But you will see, as a person's in that situation, they may want to buy a really nice used car that's low miles and get a good mechanic. Like, that might be the better method.
Yeah, and people need to scale back, right? They have to evaluate their finances, but it's still a sugar high from pandemic. Maybe government will send me more money. So there's some hope, and I guess hope dies last, right? As they say. So,
yeah, we don't want to guess at where interest rates are going. Obviously, rates, are really dependent on inflation right now, and we're still seeing high inflation, and that's affecting like all these markets. The one benefit of the U.S. is that we've been able to maintain our, I guess, level of treasury sales, even though we've pushed more into the front end of treasury bills versus treasury bonds, because that we've had enough demand, and that's kind of when we start seeing like busted auctions, lots of busted auctions for treasury sales, that's going to be the issue. That's when you can see like the rates going even higher. So obviously we want rates to go lower to kind of make it better for the consumer. We have to deal with that global market of what the value of U.S. Treasury is.
Understood. Paul, now we're close to a wrap up here. Can you let folks know where to find you, what services you offer, anything that you'd like the audience to know on how to find you?
Sure. Yeah, Fort Schuyler Advisors. We focus on mortgages, whole loans, consumer loans, anything from analyzing, providing data on, helping people with whole loan sales, advising companies that want to work out business opportunities to buy or originate. And then we'll work with fintech companies as well, kind of in terms of getting access to the capital markets and understanding the market. You can find me on LinkedIn Paul Mangione. And on Twitter, I'm Paul__Mangione. So that was the only one underscore wasn't available. So we got the __. I'm probably more active on Twitter. LinkedIn, I'll do like an article once a month, and I don't do as many kind of posts on LinkedIn as much as I should, but those are probably two places to get them. So you can also go to our website, FTSCHUYLER.com, FortSchuyler.com.
Paul, again, thanks so much for allocating time. You've been great, a lot of content, and I really appreciate your time today. Thanks again.
It's been fun. Kind of looking forward to seeing this and some of the other interviews that you've done. This has been great. Thanks, Alex.
My pleasure. Take care.
Take care, man.